Welcome to Chapter 6. In this chapter, we start learning how a business banks the money it receives from customers in a correct and safe way. Section 1, the banking system. What this section is about. When a business receives money, it must usually pay that money into the bank. This can include money received as cash or money received through the bank in other ways. To do this properly, we must understand two big ideas. First, banking procedures. This means the correct steps for handling money received so it is recorded properly and deposited safely. Second, how the banking system works. Before we learn the practical steps, we need some background knowledge about banks and how they are organized. Why you must understand banking procedures. If banking is done badly, these problems can happen. First, money can be lost or stolen. Second, the accounting records can be wrong. Third, the business may not know the true cash it has. Fourth, the examiner may test your understanding of correct processes. So in this chapter, we focus on doing banking in a controlled and organized way. Important exam message. The book uses the UK banking system as an example to teach the ideas, but the exam is not trying to test whether you know special facts about the UK. What the exam wants is this. You understand a typical clearing bank system, meaning a normal, common banking system where banks can receive payments and settle them properly. Section point 1. The banking system. Meaning of banking system. A banking system is the full set of banks and banking organizations working together in one country, plus the way they are controlled and connected. In the UK example, the book shows different types of banks. Think of it like a family of banks, where each type has a role. Now we learn the components. Component 1. The central bank, the Bank of England. The Bank of England is the central bank. A central bank is not like your everyday bank branch where you deposit money. A central bank is more like the boss-level bank for the whole banking system. Very simple duties of a central bank include: first, supervising and controlling the banking industry overall. Second, helping keep the banking system stable and safe. Third, setting rules and guidance that other banks must follow. Quick check question. Question: is the Bank of England the bank where most people open their normal accounts? Answer: no. Most people use retail banks. The central bank controls and supports the system. Component 2. Clearing banks, also called retail banks. Next, we have clearing banks, also called retail banks. A retail bank is the bank most people and businesses use for everyday banking, such as: first, opening accounts. Second, depositing money received. Third, withdrawing cash. Fourth, paying suppliers. Fifth, receiving customer payments. The word clearing connects to the idea that banks must be able to settle payments between each other. We will study the clearing idea later, but for now, you only need this simple meaning. Clearing is how banks make sure money moves correctly from one bank to another. The major high street bank groups. The book lists 5 major high street bank groups. High street means the big common banks you often see on main streets. First, Barclays Bank plc. Second, Lloyds Banking Group. Third, HSBC. Fourth, NatWest Group. Fifth, Santander. Important note for beginners, you do not need to memorize the list as facts. The key is understanding the type of bank and what it does. Quick check question. Question: what is the main job of a retail bank for a business? Answer: step by step. First, the business deposits money it receives. Second, the bank keeps the money safe in the account. Third, the bank helps the business make and receive payments. Component 3. Smaller retail banks. The book also mentions smaller retail banks. They do similar everyday banking activities, but they are smaller than the largest groups. Examples given include: first, Cooperative Bank. Second, Bank of Scotland. Third, TSB. Fourth, Virgin Money. Quick check question. Question: are smaller retail banks still retail banks? Answer: yes, they still serve customers and businesses for normal banking, just at a smaller scale. Component 4. Internet-only banks. Finally, the book mentions internet-only banks. These banks mainly operate through apps and websites, with few or no physical branches. Examples given include first, Starling, second, Monzo, third, Revolut, fourth, the Tide. Important beginner idea. Internet-only banks still provide banking services, but the way you access them is mainly online. Quick check question. Question, what makes an internet-only bank different from a high street bank? Answer, step by step. First, high street banks usually have many branches. Second, internet-only banks are mainly online. Third, both can still offer accounts and payment services. Mini summary for students. In Section 1, we learned why we must understand banking procedures before we bank money received. In Section 1.1, we learned the main parts of the UK banking system example. First, the central bank, the Bank of England, which controls the system. Second, retail or clearing banks used for everyday banking. Third, smaller retail banks, also serving customers and businesses. Fourth, internet-only banks, mainly online. We now move to Section 1.2, called the clearing system. This lesson is very important because it explains how banks collect money for checks and how banks settle with each other. Section 1.2, the clearing system. Key term, clearing. Clearing is the mechanism for obtaining payment for checks. Very simple meaning. A customer pays a check into a bank. The customer's bank cannot keep that money unless the bank that issued the check actually pays it. Clearing is the system that makes sure the money is collected correctly from the correct bank. First, understand the basic problem the clearing system solves. What happens when a check is paid in inverse? Imagine this simple story. You have a check written by someone who banks with Bank A. You pay that check into your account at Bank B. Now we have two banks involved. Receiving bank, the bank that receives the check from the customer. That is Bank B because it receives the check from you. Paying bank, the bank that must pay the money because the check is drawn on it. That is Bank A because the check comes from an account in Bank A. So Bank B must collect the money from Bank A. That collection process is called clearing. Banks settle checks and credits through the clearing system. At the end of each banking day, many checks have moved between many banks. So banks do this. They total up the value of checks that must be paid from one bank to another. They work out who owes who. Then they settle the net amounts. Why net is important? Banks do not want to send money back and forth all day for every single check. Instead, they calculate a net debt, meaning the final difference after offsets. The book's example explains slowly and step by step. The book gives an example using two banks, Lloyds and Barclays. Step 1. Understand what worth means here. When the book says 20 million worth of checks, it means customers paid in checks that total $20 million in value. Step 2. What Lloyds is asking for. The example says Lloyds may ask for settlement of $20 million of checks. These checks are drawn on Barclays. Lloyds customers paid them into Lloyds accounts. So Barclays must pay Lloyds $20 million. So we can say Barclays owes Lloyds $20 million. Step 3. What Barclays is asking for. The example also says Barclays may have $25 million worth of Lloyds checks paid in at Barclays. These checks are drawn on Lloyds. Barclays customers paid them into Barclays accounts. So Lloyds must pay Barclays $25 million. So we can say Lloyds owes Barclays $25 million. Step 4. Work out the net debt. Now compare the two amounts. Lloyds owes Barclays $25 million. Barclays owes Lloyds $20 million. To find the net position, $25 million minus $20 million equals $5 million. So the net result is Lloyds owes Barclays $5 million. What this teaches you. At the end of a day, a bank can owe money to other banks. The same bank can also be owed money by other banks. The clearing system helps calculate the final differences and settle them. How do banks actually settle these debts? The book explains that banks settle through accounts they keep at the Bank of England. Very simple explanation. Each major bank keeps an account with the central bank, the Bank of England. When Bank X must pay Bank Y, the system adjusts these accounts. The book says the balances on these accounts are called operational balances. So operational balances are simply the working balances banks hold at the Bank of England to help settlement happen. The check clearing system, step 1 to step 5. Now we follow the diagram in the book. We will explain each step in plain language. Step 1. What the receiving bank branch does. The receiving bank branch stamps its name and address on the check in addition to the crossings on the check, sorts checks paid in by customers into bundles based on which bank each check is drawn on. Meaning, all Barclays checks go in one bundle, all Lloyd's checks go in another bundle, and so on. Important extra point from the book. Non-clearing banks and building societies can participate by using one of the clearing banks as their agent. Very simple meaning of agent. A smaller bank uses a bigger clearing bank to do the clearing work for it. Step 2. Sending bundles to head office. Each branch sends the bundles by special overnight delivery to the head office of the bank that owns the branch. So branches do not exchange checks directly with every other branch. They send them up to the head office level. Step 3. Head office sends to the banker's clearinghouse. The head office sends the bundles to the banker's clearinghouse. It also includes covering lists, which are simply lists showing what is inside each bundle. For example, how many checks and total value. Step 4. Clearinghouse distributes to paying banks. The banker's clearinghouse then distributes the checks to the head offices of the correct paying banks. So, Barclays head office receives the Barclays checks. Lloyd's head office receives the Lloyd's checks, and so on. Step 5. Paying banks process and send to branches. The paying banks' head offices then process the checks using computers, distribute the checks to the branches of the banks on which the checks are drawn. Plain meaning, the paying bank checks the customer account. It decides whether the check can be paid, and the processing result goes through the system. How long should the clearing process take? The book states that the sequence should be completed within 3 working days for each check, so clearing is not instant. It is a process that takes time. What if a check is not paid? Dishonored checks. The book explains a very important situation, meaning of dishonor a check. If the paying bank dishonors a check, it means the paying bank refuses to pay it. The book says the usual reason is insufficient funds. Very simple meaning, the customer who wrote the check does not have enough money in their account. What happens next? Step by step. If a check is dishonored, step 1. The paying bank marks on the check the reason it was refused. Step 2. The check is returned by post directly to the receiving bank branch it came from. Step 3. The amount of that check had been included in the day's totals during central clearing. Step 4. The transaction between the receiving bank and paying bank is canceled by the receiving bank branch sending an unpaid claim through the clearing system. Very simple meaning of unpaid claim. A message through the clearing system that says, this check was not paid, so reverse the earlier settlement effect. Why banks need credits and debits at the Bank of England. The book explains one final point. Every day, each bank's total payable to other banks and total receivable from other banks will not be equal. So banks adjust the position between them by credits and debits in their respective accounts at the Bank of England. Very simple meanings. Credit increases the amount in a bank's account. Debit decreases the amount in a bank's account. This is how the final settlement is completed. Practice questions with step-by-step answers. Question 1. What is clearing in the simplest meaning? Answer. Step by step. First, a check is paid into a bank. Second, the receiving bank must collect money from the paying bank. Third, the system that collects and settles that money is called clearing. Question 2. In a check transaction, what is the receiving bank? Answer, step by step. First, the customer pays the check into a bank. Second, that bank receives the check. Third, that bank is the receiving bank. Question 3. Using the example, calculate the net debt. Given in words, Lloyds owes Barclays $25 million. Barclays owes Lloyds $20 million. Answer, step by step. First, take the larger amount, $25 million. Second, subtract the smaller amount, $20 million. Third, $25 million minus $20 million equals $5 million. Final answer, Lloyds owes Barclays $5 million. Question 4. What does dishonor a check mean? Answer, step by step. First, the paying bank refuses to pay the check. Second, the usual reason is insufficient funds. Third, the check is returned and the clearing position is reversed using an unpaid claim. Now we will study section 1.3, which is called banking services. This section answers a simple question. What services do banks provide to customers, and how do customers access those services? Section 1.3, Banking Services. What banking services means banking services are the different products and help a bank offers to its customers. A customer can be a person, such as an individual saving money, a business, such as a shop paying suppliers and receiving customer payments. Section 1.3.1, Retail Banking. Meaning of retail banking. Retail banking means everyday banking for individuals, small and medium-sized businesses. Retail banks are also called high street banks. Traditionally, what services did retail banks mainly offer? The book says that traditionally, the main services were current accounts, savings accounts, and, after changes in the market, mortgages. Let us make these very simple. Current account, simple meaning. A current account is an account used for daily money movements, such as receiving wages or customer payments, paying bills, using a debit card, writing checks, making transfers. Savings account, simple meaning. A savings account is mainly for keeping money aside, earning interest depending on the account type. Mortgage, simple meaning. A mortgage is a long-term loan to help buy a property, such as a house. What changed and why did banks offer more services? The book mentions deregulation of the UK market in 1982. Meaning of deregulation in very simple words. Deregulation means some rules that restricted what banks could do were reduced or removed. This increased competition. Banks expanded what they offered to customers. So, retail banks started offering many more services. Examples of services retail banks may now offer. The book gives a list. I will explain each one in a beginner-friendly way. Credit cards. A credit card allows a customer to buy now, pay later, usually with interest if not paid on time. Simple example. A small business buys office supplies using a credit card, then pays the bill later. Investments. Investments means the bank helps customers put money into things that may grow in value, such as investment funds, bonds, other investment products. Simple example, a person invests money for long-term goals like retirement. Share dealing. Share dealing means buying and selling shares in companies. Simple meaning of shares, a share is a small part ownership in a company. Simple example, a customer buys shares in a company and hopes the value increases. Loans. A loan is money a bank gives to a customer which must be repaid over time. Simple example, a business takes a loan to buy new equipment. Home insurance. Home insurance helps protect a home against risks like fire, theft, damage. Travel insurance. Travel insurance helps cover problems while traveling, such as medical emergencies, lost luggage, trip cancellation. Foreign currency. Foreign currency services help customers buy and sell other currencies, prepare money for travel or international trade. Simple example, A business needs to pay a supplier in another country, so it needs foreign currency services. Pet insurance. Pet insurance helps cover veterinary costs for pets. Wealth management. Wealth management means personal financial planning for customers with large savings, advice about investing, protecting, and growing wealth. The book also says branches may have specialist accounts and services for business customers, advisors who help businesses with their banking needs. Simple meaning. Businesses often need extra support because they may handle many payments in and out, payroll, regular supplier payments, higher value transactions. Section 1.3.2. Investment banking. Meaning of investment banking. Investment banking is usually for large corporations, wealthy individuals. Retail banking is for everyday banking. Investment banking is more about raising big money and dealing with financial markets. Main purpose mentioned in the book. Investment banks help customers when they want to raise capital by issuing shares. Very simple meanings. Capital means money needed to run or grow a business. Issuing shares means selling shares to investors to raise money. Step-by-step example. Imagine a company wants to expand. Step 1. The company needs a large amount of money. Step 2. The company decides to sell shares to the public or to investors. Step 3. The investment bank helps arrange the share issue. Step 4. Investors buy the shares. Step 5. The company receives the money and can expand. Other activities mentioned. The book says investment banking activities can include dealing in foreign currencies, commodities, derivatives. Commodities. Simple meaning. Commodities are basic goods traded in markets, such as oil, gold, wheat. Derivatives. Very simple meaning. A derivative is a financial contract whose value depends on something else, such as a currency rate, the price of oil, the price of shares. Beginner idea. Derivatives are often used to manage risk, but they can also be used for trading. Section 1.3.3. Access to banking services. Meaning of access to banking services. This part explains how customers can use banking services. The book says customers no longer have to rely only on visiting a branch in person, so customers can contact the bank by post, telephone, email, mobile, and customers can operate accounts remotely using one or more of these methods. Simple examples. Example 1. A customer checks their bank balance using a mobile app. Example 2. A customer transfers money online instead of visiting the branch. Example 3. A business receives statements by email and makes payments electronically. Quick practice questions with step-by-step answers. Question 1. What is the difference between retail banking and investment banking? Answer. Step by step. First, retail banking is everyday banking for individuals and smaller businesses. Second, investment banking mainly serves corporations and wealthy individuals. Third, investment banking helps raise large funds, for example, by issuing shares. Question 2. Give 3 examples of services retail banks may offer. Answer, step by step. First, credit cards. Second, loans. Third, foreign currency services. Question 3. What does access to banking services mean in this section? Answer, step by step. First, it means how customers can contact the bank. Second, it includes not only branches, but also post, telephone, email, and mobile. Third, it means customers can operate accounts remotely. Bank clearing system example in Chapter 6. Banking Monies Received. This diagram shows how a check moves through the banking system when the person paying and the person receiving use different banks. The people and the banks in the example, Alpha is a customer of Barclays Bank in Penzance. Beta is a customer of Lloyds Bank in Stoke. Alpha writes a check payable to Beta. Beta pays the check into his own bank branch at Lloyds Bank in Stoke. The key idea is that Beta has given the check to his bank, but the money is not fully cleared until the check has traveled through the clearing process and Alpha has actually been charged. What clearing means in simple terms. Clearing is the process that allows banks to exchange checks and then move money between the banks so that the paying customer, Alpha, is debited in Barclays, and the receiving customer, Beta, has cleared funds available in Lloyd's. This is why there is usually a time gap between paying in a check and having fully cleared money you can safely use. The timeline shown in the diagram. Monday 1st, Beta pays in the check at Lloyd's Bank in Stoke. That branch collects checks paid in by customers, including checks drawn on other branches and other banks. Next, Beta's branch and all the other Lloyd's branches send checks that are drawn on other banks to the Lloyd's London head office clearing department for clearing. This centralizes the work, keeps control strong, and makes sorting and checking more efficient. Tuesday, at Lloyd's head office clearing department, staff sort all the checks. Checks drawn on other banks, such as Barclays, are sent to the banker's clearinghouse. At the banker's clearinghouse, checks are exchanged with the other clearing banks. This is the organized meeting point where banks swap the checks they have received that are payable by other banks. After the exchange, Barclays London head office clearing department receives the checks that are drawn on Barclays branches anywhere. Wednesday, Barclays head office distributes the checks to the correct Barclays branches. In this example, the check is sent to Barclays Bank in Penzance because Alpha banks there. Barclays Bank in Penzance checks the check. If the check is in order and Alpha has sufficient funds, Alpha's account is debited. This step is crucial because it is where the payment becomes real in banking terms. The paying customer is charged, so the system can safely move value to the receiving side. Thursday. After the check has passed through the clearing process and the interbank settlement is completed, the cleared funds are made available in Beta's account at Lloyd's. This is why the diagram ends with Beta's account. Beta now has money that is cleared, not just paid in. Why the process is built this way? Central sorting and exchange reduces errors and fraud risk, and it ensures the right branch gets the right check. The delay exists because the receiving bank must give the paying bank time to verify the check and to debit the drawer's account properly. If anything is wrong, such as the check not being valid or the drawer not having enough funds, the process would stop and the check would be returned rather than being cleared. Now we start lesson 2, called the banker and customer relationship. This lesson is important because it helps you understand, first, what a banker is, second, what a customer is, third, why the difference matters in real life and in the exam. Even if you are learning accounting, you still need these definitions because banking activities involve rights, duties, and responsibilities between banks and customers. Section 2.1. What is a banker? Step 1. The meaning of banker is based on law. The book explains that the meaning of a banker is decided by 2 types of law. First, statute law. This means written laws made by the government. Second, case law. This means laws built from court decisions. In other words, people went to court, the judge decided, and that decision becomes part of legal guidance for future cases. So the meaning of banker is not only a dictionary meaning, it is a legal meaning. Step 2. What a banker does in simple words. The book says a banker is someone who does the following main activities. I will explain each one clearly. Activity 1. Putting money and checks into a customer's account. A banker will take money received for the customer, take checks received for the customer, and put them into the customer's bank account. Simple example, step by step. First, a shop receives a check from a customer. Second, the shop pays the check into its bank account. Third, the bank receives the check and records it into the shop's account. That is one part of what a banker does. Activity 2. Paying out money from the customer's account. A banker will also take out money from the customer's account when the customer instructs the bank to pay Bovals. The book mentions checks and orders paid from the account. Simple meaning: a check is a written instruction to pay money. An order can mean another type of instruction to pay, such as a payment instruction the customer gives to the bank. Simple example, step by step. First, a business writes a check to a supplier. Second, the supplier pays the check into their bank. Third, the business's bank checks the business account. Fourth, if everything is correct, the bank pays the money out from the business account. Activity 3. Keeping accounts for customers. A banker also keeps accounts for customers, such as current accounts. Simple meaning of keep accounts. The bank opens and maintains accounts, records money coming in and money going out, provides statements and balances. Quick check questions for Section 2.1. Question 1. What is a banker in very simple words? Answer, step by step. First, a banker accepts money and checks and puts them into customer accounts. Second, a banker pays money out when the customer instructs. Third, a banker keeps and maintains customer accounts. Question 2. Why do we mention statute law and case law? Answer, step by step. First, because banker is a legal definition. Second, written laws and court decisions both help define it. Section 2.2. What is a customer? Step 1. Customer is not clearly defined in statute law. The book explains something important. The term customer, meaning a customer of a bank, is not clearly defined in statute law. So how do we know the meaning? The book says case law has established the definition. That means court decisions have clarified when a person becomes a customer. Step 2. When does someone become a customer for check transactions? For check-related banking, the rule is simple. A person becomes a customer as soon as the bank opens an account for them in their name. Simple example, step by step. First, Sarah goes to the bank and applies to open an account. Second, the bank approves and opens the account in Sarah's name. Third, from that moment, Sarah is a customer for check transaction purposes. Step 3. When does someone become a customer in other situations? The book gives another situation, such as investment advice. It says a person becomes a customer as soon as the bank accepts their instructions and undertakes, meaning agrees, to provide a service. Simple example, step by step. First, Omar asks the bank for investment advice and gives instructions. Second, the bank accepts the instructions and agrees to provide that service. Third, Omar is treated as a customer for that service relationship. Step 4. Why it matters whether someone is a customer. The book explains that it is important to know whether someone is a customer because banks owe many legal duties to customers, and a bank can be sued if it does not carry out these duties properly. Simple meaning of legal duties. The bank must act properly, fairly, and carefully in certain ways. The bank must follow rules and responsibilities it owes to customers. The book also explains that the law can protect a bank when it does certain things for customers, but those protections may not apply in the same way for non-customers. So, in real life, the bank must know, is this person truly a customer or is this person not a customer yet? Quick check questions for Section 2.2. Question 1. When does a person become a customer for check transactions? Answer, step by step. First, the bank opens an account. Second, the account is opened in the person's name. Third, at that point, the person becomes a customer. Question 2. When does a person become a customer in other services, like investment services? Answer, step by step. First, the person gives instructions. Second, the bank accepts the instructions. Third, the bank agrees to provide the service. Fourth, at that moment, the person becomes a customer for that service. Question 3. Why does the customer definition matter? Answer, step by step. First, banks owe legal duties to customers. Second, customers can sue if duties are not done properly. Third, some legal protections and responsibilities depend on whether the person is a customer. Now we are in Lesson 2, and we will explain Section 2.3, called the contractual relationships. This section is about a very important idea. A bank and a customer are connected by a contract. That contract creates a legal relationship, and that legal relationship decides who owes what, who must do what, and what each side is responsible for. The book says there are 4 main types of contractual relationship that may exist between a banker and a customer: receivable and payable relationship, bailor and bailee relationship, principal and agent relationship, mortgagor and mortgagee relationship. Now, we will learn each one in very simple language with step-by-step examples. First, what contractual relationship means a contract is an agreement that the law recognizes. In banking, the contract can be created when the bank opens an account for the person and the person accepts the bank's terms, or the bank agrees to provide a service and the person accepts it. Once the contract exists, it tells us who is the receivable, meaning who is owed money, who is the payable, meaning who owes money, or, in other cases, who must take care of property, who acts for who, or who gives security for a loan. Section 2.3.1, Receivable and Payable Relationship. The simplest meaning, this relationship is mainly about money owed. Receivable means money I am supposed to receive from someone. Payable means money I'm supposed to pay to someone. Step 1. Understand the bill example from the book. The book gives a simple example. If you lend your friend Bill some money, Bill owes you money. That means Bill is your receivable because you will receive money from him. And you are Bill's payable because he must pay you back. So, in plain words, the person who owes is connected to a receivable on the other side. The person who must pay is connected to a payable on their side. Step 2. How this applies to banking deposits. Now let us connect it to a bank account. When a customer deposits money into a bank, step 1. The customer gives money to the bank. Step 2. The bank records the deposit in the customer's account. Step 3. Later, the customer has the right to withdraw that money. Step 4. That means the bank will have to pay the money back to the customer when asked. So, who owes who? The bank owes the customer. Therefore, the customer is the bank's payable, and the bank is the customer's receivable. Important clarification from the book. The book explains an idea that many beginners find confusing. The bank does not hold the client's money in trust. Very simple meaning. When you deposit money, the money does not sit in a special box with your name on it. The bank does not treat it like your exact notes and coins. Instead, the bank owes you the amount as a debt. So the relationship is like this. The bank becomes the debtor. The customer becomes the creditor. That is why the bank can use deposited money in its normal business, such as lending to other customers. And the customer does not get the bank's profit from using the money. The customer only gets whatever interest rate is agreed. Step 3. What happens if the customer has an overdraft? An overdraft means the bank allows the customer to spend more than what is in the account. So, who owes who now? Step 1. The bank pays out money for the customer even though the customer does not have enough funds. Step 2. Now the customer owes money to the bank, so the relationship is reversed. The customer becomes the bank's receivable. The bank becomes the customer's payable. Quick check questions for 2.3.1. Question 1. If you deposit money, who owes who? Answer, step by step. First, the bank must repay you when you withdraw. Second, so the bank owes the customer. Third, customer is bank's payable. Bank is customer's receivable. Question 2. If you are overdrawn, who owes who? Answer, step by step. First, the bank has effectively lent you money. Second, so you owe the bank. Third, customer is bank's receivable. Bank is customer's payable. Section 2.3.2. Bailor and bailee relationship. The simplest meaning. This relationship is about property placed into safekeeping, not normal bank deposits. The book says this happens when a bank offers a safe deposit service. Examples of property could be important documents, jewelry, valuable items that need protection. Keywords. Bailer means the owner who gives the property for safekeeping. Bailee means the person or organization that receives the property to keep it safe. In the book's wording, the customer is the bailer. The bank is the bailee. What the bank must do step by step. When the bank accepts the customer's property for safekeeping, the bank has obligations. The book gives two main obligations. Obligation 1, reasonable care. The bank must take reasonable care to safeguard the property against damage, loss. Simple meaning of reasonable care. The bank must act like a careful, responsible professional. For example, proper security, proper controls, proper storage. Obligation 2, redeliver only to the right person. The bank must redeliver the property to the customer or to another person the customer has authorized it, and the bank must not deliver it to any other person. Key term bailment. The book says this arrangement is known in law as a bailment. Very simple meaning. Bailment is the legal arrangement where property is handed to someone for safekeeping and must be returned properly. Quick check questions for 2.3.2. Question 1. In a safe deposit service, who is the bailer? Answer: the customer. Question 2. In a safe deposit service, who is the bailee? Answer: the bank. Question 3. What are the bank's two big responsibilities? Answer step by step. First, take reasonable care to protect the property. Second, return it only to the customer or an authorized person. Section 2.3.3. Principal and agent relationship. The simplest meaning. This relationship is about one person acting for another. The principal is the person who wants something done. The agent is the person who acts on behalf of the principal. The book defines an agency relationship like this. One person, the agent, acts for another person, the principal, usually to do business between the principal and a third party. Why do people use agents? The book gives a clear reason. Sometimes the principal does not have enough specialist knowledge to deal with the third party. So the principal uses an agent who has experience, knowledge, systems, contacts. Simple examples, step by step. Example 1, accountant and tax authorities. Step 1, a business must deal with tax authorities. Step 2, the business may not understand all the rules. Step 3, the business hires an accountant. Step 4, the accountant deals with the tax authorities for the business. Result, the business is the principal, the accountant is the agent. Example 2, employment agency. Step 1, an employer needs a worker quickly. Step 2, the employer uses an employment agency. Step 3, the agency finds a suitable employee or a temporary worker. Result, employer is principal, employment agency is agent. The book says a bank may act as agent for its customers. It also says the bank may use other agents, such as stockbrokers, to handle certain business. A common example in the book is insurance. Step 1, the customer wants insurance. Step 2, the bank arranges insurance for the customer. Step 3, the bank is acting as an insurance broker. Result, the bank is the agent and the customer is the principal. Quick check questions for 2.3.3. Question 1. Who is the principal? Answer, the person who wants the action done and gives instructions. Question 2. Who is the agent? Answer, the person who acts on behalf of the principal. Question 3. Give one bank example of agency. Answer, step by step. First, customer wants insurance. Second, bank arranges it. Third, bank is agent, customer is principal. Section 2.3.4. Mortgagor and mortgagee relationship. The simplest meaning. This relationship happens when a customer takes a loan from a bank and the loan is secured by a mortgage or charge over an asset. The book gives property as a common example. Keywords. Mortgagor is the customer who gives the mortgage. Mortgagee is the bank that receives the mortgage as security. So, customer equals mortgagor. Bank equals mortgagee. Step-by-step explanation. Step 1. The customer asks the bank for a loan. Step 2. The bank agrees, but it wants security. Step 3. The customer grants a mortgage over an asset, such as a property. Step 4. The bank lends the money. Now look at the who owes who part. The bank pays out the loan amount. The customer must repay the loan over time, so the customer owes the bank. The book also explains an important protection. If the customer does not pay back the loan, the bank may be able to sell the asset or assets to recover its money. Quick check questions for 2.3.4. Question 1. Who is the mortgagor? Answer: the customer. Question 2. Who is the mortgagee? Answer: the bank. Question 3. Why is a mortgage important to the bank? Answer: step by step. First, it provides security. Second, if the customer fails to repay, the bank may recover money from the secured asset. Section 2.4. Section Summary. This part is a summary table in the book. Its job is to help you quickly remember the 4 contractual relationships we learned in Section 2.3. The easiest way to use this summary is this method. Step 1. Look at the transaction. Step 2. Ask, who owes money, or who is responsible for the service? Step 3. Match it to the correct relationship name. Step 4. State the role of the bank and the role of the customer. Now let us go through each line of the summary in a very clear way. 1. Receivable and payable when the customer deposits cash at the bank. Transaction. Customer deposits cash at bank. Step 1. The customer gives cash to the bank. Step 2. The bank must repay that amount when the customer asks to withdraw, so the bank owes the customer. Result. Bank is receivable. Customer is payable. Simple meaning. From the customer's point of view, the customer will receive money back later. From the bank's point of view, the bank must pay the customer later. 2. Receivable and payable when the bank gives the customer money on overdraft. Transaction. Bank gives customer money on overdraft. Step 1. Overdraft means the customer spends more than what is in the account. Step 2. The bank is effectively lending money to the customer, so the customer owes the bank. Result, bank is payable, customer is receivable. Simple meaning, the bank has paid out money. The bank must receive money back from the customer. 3. Bailor and bailee, when the customer stores property in the bank's safe deposit facilities. Transaction, customer stores property in bank's safety deposit facilities. Step 1. The customer owns the property. Step 2. The customer gives the property to the bank for safekeeping. So the customer is the bailor and the bank is the bailee. Result, bank is bailee, customer is bailor. Simple meaning, the bank must protect the property and return it to the correct person. 4. Principal and agent, when the bank arranges insurance for the customer. Transaction, bank arranges insurance for customer. Step 1. The customer wants insurance. Step 2. The bank acts on behalf of the customer to arrange it with an insurance provider. So the customer is the principal and the bank is the agent. Result, bank is agent, customer is principal. Simple meaning, the bank is doing the action. The customer is the one who asked for it and is responsible for the decision. 5. Mortgagor and mortgagee, when the bank lends money with a mortgage over the customer's property. Transaction. Bank lends money to customer with a mortgage on customer's property as its security. Step 1. The bank gives a loan to the customer. Step 2. The customer gives security, usually a charge over property. Step 3. If the customer does not repay, the bank may recover money from the secured asset. Result, bank is mortgagee, customer is mortgagor. The summary also links this to money owed. The bank has paid out the loan amount. The customer must repay it. Section 2.5. The fiduciary relationship. This section introduces a new idea. It says this type of relationship is not contractual, so it is not the normal contract relationship we discussed earlier. Meaning of fiduciary. In simple words, a fiduciary relationship is a special relationship where one party must act with good faith, with honesty, and without taking unfair advantage. The book explains why this can happen with banks. Why can a fiduciary relationship happen between a bank and a customer? Sometimes the bank is in a position of strong influence, specialist knowledge, power over decisions. The book calls this undue influence. Meaning of undue influence, in very simple words. Undue influence means the bank could pressure the customer or strongly push the customer. So the customer might do something they do not really want to do. Because of that risk, the law expects the stronger party to act properly. So in this special relationship, the bank must act in good faith. The book also calls this a fiduciary relationship or a special relationship. Simple example to understand it. Imagine a customer does not understand financial products. Step 1. The customer asks the bank for advice. Step 2. The bank has more knowledge. Step 3. The customer trusts the bank. Step 4. If the bank abuses that trust, that is a problem. So the idea of fiduciary duty is connected to trust and fairness. Section 2.6. The rights and duties of bankers and customers. This section is very exam-friendly because it is organized into 3 parts. Section 2.6.1. The rights of bankers. Section 2.6.2. The duties of customers. Section 2.6.3. The duties of bankers, which are also the rights of customers. Before we start, one key idea. A right is something a person is allowed to do. A duty is something a person must do. Section 2.6.1. The rights of bankers. The book says bankers' rights arise on the basis of accepted legal or moral justice. Now the rights listed in the table. Right 1. Making charges or commissions. Meaning, the bank may charge fees for services. But the book adds an important condition. Charges must be reasonable. Also, this is separate from charging interest on overdrafts. Simple example, a bank may charge a fee for managing an account if the fee is reasonable. Right 2. Using customers' money. This connects back to what you learned earlier. Deposited money is not held on trust, so the bank can use the deposited money to earn interest or income. Simple meaning, the bank can use deposits in its banking activities. The customer does not own the exact notes and coins. The customer has a right to repayment of the amount. Right 3. Demanding repayment of overdrawn balances. The book states, overdrafts are repayable on demand, meaning the bank can ask for the overdraft money back when it chooses, unless separate terms state or imply otherwise. Simple example, if you are overdrawn, the bank can require you to repay unless you have an agreement that allows time. Right 4. Possessing a lien over securities. This is a key word. A lien is a right to retain possession of another person's property until a debt is settled. The book adds an important limitation. This does not apply to items held in safe custody, such as jewelry, but it would apply to deposits of property given as informal security for a loan. Simple example. If a customer owes the bank money and has provided property as security, the bank may retain that property until the debt is cleared, depending on the situation. Section 2.6.2. The duties of customers. The table gives 2 major duties. Duty 1. Ensuring fraud is not facilitated when drawing checks. This means the customer must be careful so they do not make fraud easy. The book gives examples of careless behavior. Do not sign a blank check and then send it through the post. Also, customers must tell the bank about any known forgeries. Simple meaning of forgery. Someone fakes a signature or changes a check dishonestly. Duty 2. Indemnifying the bank when it acts on the customer's behalf. Key word, indemnify. Indemnify means secure the bank against possible loss or damage. The book gives a common example, a check guarantee card. Simple idea. Step 1. The customer uses a check guarantee card. Step 2. The check may cause an overdraft. Step 3. The customer agrees to protect the bank from loss in that situation. Step 4. The customer must then repay the overdraft created on demand. Section 2.6.3. Duties of bankers, which are also the rights of customers. The book explains, A duty is a task or action a person is bound to perform for moral or legal reasons. Now, the bank duties listed. Duty 1. Honor a customer's check, meaning the bank should pay a check when it is properly presented, but only if these conditions are met. First, the check is correctly made out. Second, there are sufficient funds in the account. Third, there is no legal reason preventing payment. The book gives an example of a legal reason. Insolvency of the customer could bar payment from the account. Duty 2. Receipt of customer's funds, meaning when funds are received, the bank must credit them to the customer's account. Simple example. If a customer deposits cash, the bank must record it in the account. Duty 3. Repayment on demand, meaning the bank must repay the customer when properly requested. The table adds conditions. There must be a written request during normal bank opening hours, at the customer's branch, or another agreed bank or branch. Simple example. The customer requests a withdrawal properly, and the bank repays. Duty 4. Comply with customer's instructions, meaning if there are sufficient funds, the bank must do what the customer requests. Simple examples. Pay a supplier, set up a transfer, stop a check if rules allow and timing is correct. Duty 5. Provide a statement, meaning the banker must provide a statement showing transactions on the account. The book also mentions this should be done in a reasonable time, and details of the balance should be provided on request. More bank duties shown on the next page. Duty 6. Confidentiality. A bank should keep customer affairs confidential. The book lists 4 recognized exceptions where disclosure may happen. First, disclosure may be required by law. Second, there may be a public duty to disclose. Third, the interest of the bank may require disclosure, for example, when the bank sues the customer to recover what is owed. Fourth, the customer may have given express or implied consent. For example, the customer asks a third party to obtain a banker's reference. Duty 7. Advise of forgery, meaning the bank must tell the customer when it becomes apparent that checks bearing a forged signature are being drawn on the account. Duty 8. Care and skill, meaning bankers are expected to use care and skill, both for professional reasons and to ensure statutory protection under some legislation. Very simple interpretation. The bank must act competently, not carelessly. Duty 9. Closure of accounts, meaning the bank must provide reasonable notice if it wishes to close an account. Notice should allow the customer time to make other arrangements. Very important note at the bottom of the page. The book states, there is no duty for the customer to keep records of the account, and there is no duty to check statements. So the responsibility, meaning the onus, is on the bank to apply transactions correctly. However, the book adds a practical point for good business. It is good practice to monitor bank accounts and reconcile the bank account back to the general ledger. This links directly to accounting control and bank reconciliations. Practice questions for Section 2.6. Question 1. Can a bank use customer deposits to earn interest? Answer, step by step. First, deposits are not held on trust. Second, the bank owes repayment but can use the funds. Third, so yes, the bank can use deposits to earn interest. Question 2. What is one customer duty when writing checks? Answer, the customer must not facilitate fraud and must report known forgeries. Question 3. Name one exception to confidentiality. Answer, disclosure may be required by law. Question 4. If a bank wants to close an account, what must it do? Answer, it must give reasonable notice so the customer can make arrangements. Now we start Lesson 3, which is called Procedures for Banking Cash. This lesson teaches you how a business prepares cash receipts to be paid into the bank in a careful and controlled way. Why do we need careful procedures? Because cash is easy to lose, easy to miscount, and easy to steal. So we use clear steps to make sure the amount being banked is correct. Section 3.1. The paying in slip. What is a paying-in slip? A paying-in slip is a form used when a person or a business wants to pay money into a bank account. The bank treats the paying-in slip as a summary document. Simple meaning of summary document. It is a document that adds up the cash and other money being banked. It shows the bank what total should be credited to the account. What the paying-in slip usually contains. A paying-in slip normally asks for information such as the date, the bank account details, meaning the account number and sometimes the branch details, the name of the person or business paying in, a reference so the business can identify the deposit later, a list of notes and coins by denomination, the total amount of cash, sometimes a separate line for checks if checks are included. Keyword, denomination. A denomination means the face value of a note or coin. Examples of denominations in words: £50 note, £20 note, £10 note, £5 note, £2 coin, £1 coin, 50 pence coin, 20 pence coin. Important instruction when banking cash receipts. When you bank cash receipts, the lesson tells you two key rules. First, cash must be properly counted and sorted. Second, notes and coins must be listed by denomination on the paying-in slip. Let us break that down. Rule 1. Count and sort cash properly. Sort means you separate money into groups, such as put all £50 notes together, put all £20 notes together, put all £10 notes together, put all coins together, then split coins by type. This makes counting easier and reduces mistakes. Rule 2. List notes and coins by denomination. This means you do not only write one total number. Instead, you show the bank the breakdown, such as how many £50 notes, how many £20 notes, how many £10 notes, and so on. This helps the bank check your deposit quickly. Why businesses like paying in slips? A paying-in slip helps a business in 3 ways. First, it reduces counting mistakes. Second, it creates evidence of what you paid into the bank. Third, it supports later tasks like bank reconciliation, meaning matching the bank statement to your accounting records. Key term for Lesson 3. Float. In this lesson, you also meet the word float. A float is the money kept in the till at the end of the day so that the next day there is some cash available to give change to customers. Simple example. Step 1. A shop finishes the day with lots of cash sales. Step 2. The shop does not bank all cash. Step 3. The shop keeps a small amount in the till for change tomorrow. That small amount is the float. Step 4. The rest is prepared for banking using a paying-in slip. Section 3.2. Procedures for preparing a paying-in slip. This section gives good practice steps to follow when preparing money for banking. We will go step by step and explain what each step means and why it matters. Step 1. Count the cash, as described above. What to do? Step by step. Step 1. Separate notes by denomination. Step 2. Count each denomination carefully. Step 3. If the business has a second person should recount for control. Step 4. Separate coins by denomination. Step 5. Count coins carefully by denomination. Why this step matters? Because if you count incorrectly, the bank may credit the wrong amount. Your accounting records will not match the bank statement, and you will waste time investigating the difference. Simple counting example, step by step. Imagine the business has these notes: one £50 note, two £20 notes, three £10 notes, four £5 notes. Step 1. Multiply each denomination by the number of notes. Step 2. Add the totals. So, one £50 note equals £50, two £20 notes equals £40, three £10 notes equals £30, four £5 notes equals £20. Now add them. £50 plus £40 plus £30 plus £20 equals £140. That is the cash total from notes. Then you do the same for coins. Step 2. Add up on a separate piece of paper how much cash you are banking. What this really means. This step is a double check. You calculate the total again separately away from the paying in slip to reduce mistakes. How to do it, step by step. Step 1. Write down each denomination and its total. Step 2. Add the notes totals together. Step 3. Add the coins totals together. Step 4. Add notes total plus coins total. Step 5. This gives the calculated cash total. Why the lesson says separate piece of paper? Because it helps you. Avoid writing the wrong number in the wrong box. Avoid missing a denomination. Keep a clear trail of how you calculated the total. A good habit is, keep that working paper in your records, especially for larger deposits. Step 3. Compare the calculated total to the total according to the cash register. The lesson tells you to compare your calculated total with the total shown by the cash register. What is the cash register total? The cash register total is the amount the system says you received from customers. This could be from a cash register machine, a point of sale system, a daily sales report. Why we compare the two totals? Because the two totals should normally match. If they do not match, it warns you that something may be wrong, such as a counting mistake, an error in recording a sale, missing cash, giving too much change, a refund not recorded properly, mixing in or removing the float without recording it. What to do if the totals do not match? Step 1. Recount the cash. Step 2. Check whether you kept a float. Step 3. Check whether any petty cash was taken from the till. Step 4. Check refunds, discounts, and void sales on the register report. Step 5. Only prepare the paying in slip when the difference is explained. This is a strong internal control. How Section 3.2 connects to real accounting? Even though Lesson 3 looks like bank paperwork, it affects accounting accuracy. If the cash counted is wrong, then your bank deposit will be wrong, your cash book will be wrong, and later, your bank reconciliation will be harder. So these procedures protect the quality of your records. We are still in Chapter 6 of FIA FA1, and now we will study Section 3.3. Example, banking cash. This example shows you step by step how a business prepares cash to take to the bank and how the business checks that the cash amount makes sense compared to what the till says was received. Section 3.3. Example, banking cash. 1. What information the example gives us. After the day ends, the business sorts and counts all the cash that will be taken to the bank. The counted cash is 5 notes of $50, 110 notes of $20, 560 notes of $10, 40 notes of $5, 6 bags, each bag has 20 coins of $1, 2 bags, each bag has 10 coins of 50 cents, 10 bags, each bag has 50 coins of 20 cents, other silver coins worth $32.20, bronze coins worth 93 cents. The example also tells us about the float. The float in the till at the end of yesterday was $34.90. The float in the till at the end of today is $43.62. And the till summary says that the total receipts received today were $8,517.41. 2. Work out the value of each group of notes and coins. Now we calculate how much money each group is worth. A. Notes. 5 notes of $50. 5 times $50 equals $250. 110 notes of $20. 110 times $20 equals $2,200. 560 notes of $10. 560 times $10 equals $5,600. 40 notes of $5. 40 times $5 equals $200. B. Coins in bags. 6 bags. Each bag has $21 coins. First, find the number of $1 coins. 6 times 20 equals 120 coins. Each coin is $1, so the value is $120. 2 bags. Each bag has 10 50-cent coins. First, find the number of 50-cent coins. 2 times 10 equals 20 coins. Each coin is 50 cents, so 20 times 50 cents equals $10. 10 bags, each bag has 50 20-cent coins. First, find the number of 20-cent coins. 10 times 50 equals 500 coins. Each coin is 20 cents, so 500 times 20 cents equals $100. C. Other loose coins. Other silver, already counted as $32.20. Bronze, already counted as 93 cents. 3. Add everything to get money to be banked. Now we add all the values, $250 plus $2,200 plus $5,600 plus $200 plus $120 plus $10 plus $100 plus $32.20 plus 93 cents. This gives a total cash amount to take to the bank of $8,513.13. This amount is the cash physically being put in the bank deposit. 4. Understand the float and why we must adjust for it. A float is money left in the till so that the next day staff can give change to customers. If the float changes, it affects the comparison between what the business banks and what the till says the business received. In this example, today's float is $43.62. Yesterday's float was $34.90. So the float increased by $43.62 minus $34.90 equals $8.72. What this means in simple words, the business kept an extra $8.72 in the till. That extra cash came from today's takings. Because it stayed in the till, it was not included in the cash taken to the bank. So, when we reconcile to the till receipts, we must add the increase in the float to the banked cash. This makes the comparison fair. 5. Reconcile the cash to the till records. Now we compare. Money to be banked, $8,513.13. Add the increase in the float, $8.72. So, $8,513.13 plus $8.72 equals $8,521.85. This figure represents what the cash takings would look like if the float had not increased. Now compare to the till summary. Receipts according to the till, $8,517.41. Now calculate the difference. $8,521.85 minus $8,517.41 equals $4.44. So, the reconciliation difference is $4.44. 6. What to do with a small difference. The example explains that this difference is very small, so it would normally be ignored or written off. Written off here means the business accepts it as a small, unavoidable difference. For example, a small counting error or tiny till rounding issues. And it records it according to company policy rather than spending time investigating it. The example also explains that a business should set a limit, for instance, $5. If the difference is over that limit, the business investigates. In this case, the difference is $4.44, which is below $5, so it would normally not be investigated. 7. Completing the paying-in slip for this deposit. After the cash is counted and agreed, the paying-in slip is completed. On the paying-in slip, the business records the total value for each denomination, not the number of notes or coins. So the slip shows $50 notes, $250. $20 notes, $2,200. $10 notes, $5,600. $5 notes, $200. $1 coins, $120. 50-cent coins, $10. 20-cent coins, $100. Other silver coins, $32.20. Bronze coins, 93 cents. Then the slip totals the cash and enters. Total cash, $8,513.13. Important clarification. The paying in slip shows only what is being taken to the bank. The float increase is used only for the reconciliation check against the till receipts. It is not added onto the paying in slip because that extra float money is staying in the till, not going to the bank. At this point, the paying in slip and the cash are ready to be taken to the bank. 3.4. Security procedures when banking cash. When a business takes cash to the bank, there is always a risk that the cash could be lost, stolen, or mishandled, so a business uses security procedures. A security procedure is simply a rule or method that helps keep the money safe. The book reminds us that we already looked at some security procedures in Chapter 5, and now it gives us some general points that should be used where possible. Point A. Vary the time of the visit and vary which staff member takes the money. Meaning in simple words, do not go to the bank at the same time every day and do not always send the same person. Why this matters? If a business always goes to the bank at the same time, criminals can learn the pattern. A pattern makes it easier for someone to plan theft. How a business can do this? Step by step. Choose a time window instead of one fixed time. Example, sometime between late morning and early afternoon. Rotate the staff member who goes to the bank. Example, one day the supervisor goes, another day a different trusted staff member goes. Keep the plan confidential inside the business. Only the people who need to know should know. Main idea, predictability creates risk. Changing routines reduces risk. Point B, if possible, send more than one person, especially when using the night safe. Meaning in simple words, if you can, send 2 people instead of 1. This is especially important if you are using a night safe. What night safe means. A night safe is a secure drop box at a bank where you can deposit cash outside normal banking hours. Why sending more than one person helps? There is safety in numbers. One person can focus on carrying and depositing the cash. The other person can focus on awareness and safety. The book's practical advice, explained clearly. One person should drive. The other person should carry the money and deposit it into the night safe. The driver should also watch over the person carrying the cash. Main idea, 2 people reduce risk and improve control. Point C. If very large amounts of cash are banked regularly, consider using a security firm. Meaning in simple words, if the business often takes large amounts of cash to the bank, it may be safer to hire a professional security firm to collect and deliver the money. What a security firm does, in simple terms, they come to your business at a planned time. They take custody of the cash. They transport it safely to the bank, often using secure vehicles and trained staff. Why a business would choose this? Large cash banking creates higher risk. Professional collection reduces the chance of theft. It also creates a stronger chain of custody, meaning it is clearer who handled the money at each stage. Main idea, bigger amounts of cash usually need stronger security. Point D, fill in the customer's retained part of the paying in slip so you have a record. Meaning in simple words, when you complete a paying in slip, you must fill in the section that the customer keeps. The book notes this is on the left-hand side. This creates a record that the cash was paid into the bank. Why this is important? It is evidence of what you intended to deposit. It supports accounting records and helps with checking later. If there is ever a dispute or missing deposit, the business has its own record. How to apply this properly? Step by step. Complete the paying in slip carefully. Make sure the customer's retained section is filled in clearly. Keep that retained part in the business records for that day. For example, with the cash register summary and banking paperwork. The book also notes that you can record the information elsewhere if you wish, but the key point is, always keep a reliable record of what you banked. Main idea, good records protect the business and support reconciliation. Lesson 4. Procedures for banking checks, FIA FA1. Lesson 4 teaches you how to pay checks into the bank correctly and exactly what details the bank needs so the checks can be processed through the clearing system and credited to the correct account. 1. What information the paying in slip must include when checks are banked. When you pay checks into the bank, the paying in slip must include these details. 1. Name of the drawer or the endorser. Drawer means the person who writes and signs the check. Their bank account will later be debited when the check clears. Endorser means the person who signs on the back of the check to transfer it to someone else. This matters when a check is passed on to another party. 2. Amount of each check. The bank needs the amount for each check so it can identify each item and process it correctly. 3. Total value of checks banked. This is the total of all the check amounts added together. 4. Number of checks banked. This is a control check. If you write that you paid in 8 checks, the bank should physically receive 8 items. These requirements reduce mistakes and create a clear audit trail, meaning proof of what was deposited. 2. Using the paying in slip for checks, front and back. Key rule in Lesson 4. You use the same paying in slip for checks as you use for cash. But when you bank checks, you must also complete the back of the paying in slip. What is recorded on the front? The front usually shows your bank account details, the total cash being paid in, if any, the total checks being paid in, the overall total. On the front, you normally record totals, not the detail of every check. What is recorded on the back? The back is where you list the check details. This is usually called something like details of checks. On the back you list the drawer name for each check, the amount for each check. You may also see running totals, such as carried forward, meaning a subtotal when the list continues. Subtotal brought forward, meaning the previous subtotal carried into the next space. Total carried over, meaning the final total of all check items in reverse. This structure is designed so even if there are many checks, the totals stay controlled and traceable. 3. Why check details matter? Because checks must clear. A check is not the same as cash. It usually goes through clearing, meaning your bank requests the money from the drawer's bank. The check may be returned unpaid, for example, because of insufficient funds, a stopped check, or a signature problem. If a check is returned, the bank may reverse the credit that was given to your account. That is why the bank needs a clear list of each check and its amount. If a problem happens, the bank can identify exactly which check caused it. 4. The book's example in Lesson 4, explained fully. In the example, you are depositing checks, a postal order, and cash, and you must complete the paying in slip and the check listing. Part A. Checks and postal order, the check section total. The checks are from these drawers with these amounts. B. Weeman, $940. Pacific Limited, $1,721.50. S. McManus, $94.26. A. Singh, $19.29. P.L. Ferguson, $57.37. Dex Limited, $42.91. M. Green, $12.50. Now add them. Check subtotal equals $2,887.83. There is also a postal order. S.P. Sykes postal order, $15. Now add the postal order to the check subtotal. Total check items equals $2,902.83. So, on the front of the paying in slip, checks total equals $2,902.83. And on the back of the paying in slip, you list each drawer and amount. You show the subtotal carried forward as $2,887.83. Then you add the postal order $15. Then you show the total carried over as $2,902.83. Also, the number of items is important. There are 7 checks plus 1 postal order, so the number of check type items banked equals 8. Part B. Cash, counted and listed by denomination. The cash section shows notes and coins counted by type. Notes. 2 $50 notes equals $100. 5 $20 notes equals $100. 97 $10 notes equals $970. 42 $5 notes equals $210. Now add the notes. Notes total equals $1,380. Coins. 804 $1 coins equals $804. 80 50-cent coins equals $40. 100 20-cent coins equals $24. Other silver equals $34.85. Bronze equals $9.28. Now add the coins. Coins total equals $912.13. Now add notes plus coins. Cash total equals $2,292.13. So on the front of the paying in slip, cash total equals $2,292.13. Part C. Total deposit, cash plus checks. Now add the cash total and the checks total. Total deposit equals cash total plus checks total. Total deposit equals $2,292.13 plus $2,902.83. Total deposit equals $5,194.96. So on the front of the paying in slip, total equals $5,194.96. This is the final control check. The total deposit must match what you are physically taking to the bank. 5. What Lesson 4 is training you to do. The controls. Lesson 4 is not just about filling a form. It is about control and evidence. Completeness control. The number of checks written on the slip must match the number handed to the bank. Accuracy control. Each check amount is listed, so mistakes are easier to detect. Traceability. If a check is lost or returned unpaid, you can identify it by drawer and amount. Accounting support. The paying in slip becomes a source document that supports the cash book entry and helps later during bank reconciliation. 6. Final memory summary for Lesson 4. Banking checks requires more detail than banking cash because checks must clear. Use the same paying in slip as cash, but you must also complete the back-to-list check details. Always include drawer or endorser name, each check amount, the total value, and the number of checks. Lesson 4 continued. Returned or dishonored checks. The next part of Lesson 4 explains what can go wrong after you receive a check and bank it. Sometimes the bank later sends the check back and removes the money from your bank account because the check has not been paid. The book calls this a returned check or a dishonored check. What dishonored means in practice, you receive a check from a customer and you pay it into the bank. At first, it may look like the money has gone in. Later, the bank finds out the check cannot be paid and sends it back. The bank then takes the amount back out of your bank account. Accounting meaning, the payment is no longer valid, so the customer still owes you the money. Section 4.1. Returned or dishonored checks. The text highlights 2 main reasons a check may be dishonored for payment: insufficient funds, stolen checks, and forgery. It also explains another common reason: the check is wrongly completed or out of date. Section 4.1.1. Insufficient funds. What it means. The customer's bank account does not have enough money to cover the check when the bank tries to pay it. Why the bank might still honor it sometimes. The text explains that banks will normally honor a check in certain situations, including the check is for an amount lower than the check guarantee card limit. There is evidence that a check was made between the check and the guarantee card, such as the card number written on the back of the check. What happens when it is dishonored? The check is returned to you, commonly marked with words such as refer to drawer. Drawer means the person who wrote and signed the check. You must then contact the customer and collect the money by another method, such as cash, bank transfer, or a replacement check. How this affects your accounting records. When the check is returned, you treat it as if the customer never paid. Practically, you put the debt back onto the customer's account. The customer becomes a receivable again. Remove the money from the bank account in your books because the bank removed it in real life. Simple classroom wording of the entry. Debit the customer account to show the customer owes again. Credit the bank account to remove the deposit that is no longer valid. Section 4.1.2. Stolen checks and check guarantee cards. What it means. A check can be dishonored because it is connected to fraud. For example, the checkbook was stolen. The signature of the drawer was forged. Key point. The text stresses, if the signature is forged, the check is invalid and worthless. Even if you accepted it, and even if it looked consistent with a check guarantee card at the time, a stolen and forged check can still be returned unpaid. What you may see when it is returned. The bank may return the check with notes or markings indicating problems such as the checkbook and check guarantee card were reported stolen. The signatures differ, or other wording showing it is not a genuine payment instruction. Practical business impact. You lose the expected money. You need to chase the customer for a legitimate payment method. You should also tighten internal controls around accepting checks, such as checking identification and being cautious with unusually large or unusual payments. Section 4.1.3. Wrongly completed or out-of-date checks. This section explains that a check can be returned even when there is no fraud and even when the customer has money, simply because the check is not acceptable for processing. Common examples in the text. Mismatch between words and figures. The amount written in words does not match the amount written in numbers. Banks will typically return it rather than guess which amount is correct. Post-dated checks. The check is dated in the future, such as next month, so the bank returns it instead of paying it. Stale checks. If a check is more than 6 months old, the bank will not present it for payment. Practical business message. Bank checks promptly. Delays increase the risk that the check becomes out of date. If the check is returned for completion or date problems, you return it to the drawer and request a replacement. Accounting impact. Just like the other return check situations, the customer still owes you money. You reverse the bank check in your records and reinstate the receivable until a valid payment is received. The overall takeaway from this part of Lesson 4. A check you bank is not always final immediately. A returned or dishonored check means your bank balance decreases again and the customer debt comes back, so you must follow up and collect payment properly while keeping clear documentation for your records and controls. Lesson 5. Procedures for banking debit and credit card transactions. This lesson explains what a business must do when it accepts debit card and credit card payments that are processed manually and then paid into the bank. The key idea in the book is, you do not just take the individual card vouchers to the bank one by one. You first summarize them on a summary voucher. Then you bank them using the usual paying in slip. The book stresses that the paying in slip is still used, but extra documents are prepared first. What manual card processing means in this lesson. In modern shops, card payments usually go through an electronic terminal automatically. In the book, this lesson describes an older or less common method where the retailer produces paper card vouchers for each card transaction and later banks them. The book notes that manual processing is becoming increasingly rare, but it is still described so you can understand the documents and the banking flow. How the money flows. The retailer collects card vouchers during the day. The retailer pays those vouchers into their bank account. The bank sends the vouchers through the banking system to the card issuer for settlement. The card issuer pays the bank, and the bank credits the retailer. So, the vouchers are evidence supporting the amount the retailer is claiming from the card system. The documents you must understand. Card voucher. A card voucher is the paper proof for one card transaction, one sale, or one refund. It supports the amount the business is claiming. Summary voucher. The summary voucher is the control document used to summarize all card vouchers that are being banked together. In the book, the summary voucher consists of an original top copy plus 2 copies with carbon paper between. The bottom copy is the processing copy. The processing copy is the one that is sent to the bank for processing. The retailer keeps 2 copies for internal records, including a copy of the summary voucher itself. The summary voucher is imprinted with the retailer's plastic card and includes the business details, including the bank account information. The book explains it is imprinted using the same type of machine used to imprint customer card vouchers. 5.1. Card summaries. What you do and why you do it. Purpose. Card issuers require businesses to summarize all card transactions being banked. This creates a clear control trail. What transactions happened? What total amount is being banked? What evidence supports that amount? The individual vouchers. What is recorded? The book highlights an important difference from cheques. Unlike cheques, only the amount of each card transaction needs to be entered on the back of the processing copy of the summary voucher. Names of customers are not required in the same way they are when listing cheques. Why this matters for accounting control. From an accounting perspective, the summary voucher is a batch control. It supports completeness. All card vouchers for the banking batch are listed. It supports accuracy. The total on the summary voucher should match the total being banked. It supports audit trail. You can trace from bank deposit to the batch summary to the individual vouchers. Lesson 5.2. Example of banking card vouchers. This example shows how a business banks a day's debit or credit card vouchers when card payments are processed manually. The book's purpose here is to teach you how to summarize many individual card vouchers into one summary voucher, then take the correct documents to the bank, and finally file what you keep so you can answer queries later. What information you start with in this example? You have a bundle of individual card transaction vouchers for the day. In the example, the vouchers include many sales and one refund. The sales amounts are $26.41, $32.99, $32.19, $100.40, $22, $46.99, $37.80, $12.95, $12.95, $14.48, $136.48, $12.95, $112.95, $11.80, $50, $6.71. Their fund amount is $22. From these vouchers, total sales equal $670.85. Total refunds equal $22. Net amount to be banked equals $648.85. The count is also important. 15 sales vouchers, 1 refund voucher, 16 vouchers in total. Why the book uses a summary voucher? Instead of the bank and the card issuer receiving a large pile of separate paperwork with no structure, the business prepares one summary voucher. That summary voucher groups the day's card activity into a clear total, backed up by the individual vouchers. Think of it like this. The individual vouchers are the detailed evidence. The summary voucher is the control document that totals and explains the bundle. Step-by-step process in the example. Step 1. List each transaction amount on the back of the processing copy. You write the amount of each card voucher on the back of the processing copy of the summary voucher. What this achieves, it creates a complete list of the day's card transactions in one place. It allows anyone to check the total quickly without re-adding from scratch. It reduces the risk of missing a voucher or adding one twice. Important detail from the example layout. The list is entered in a controlled listing area. The form warns not to tick or write outside that area, because marks outside the correct area can cause processing problems or confusion. Practical note, the book includes: if there are many vouchers, the amounts can be listed separately rather than on the summary voucher itself. The key control is that every voucher amount is captured and traceable. Step 2. Transfer the totals and the number of vouchers to the front of the summary voucher. After listing the amounts, you calculate the totals and carry them to the front of the summary voucher. In the example, you show sales vouchers count equals 15, amount equals $670.85. Refund vouchers count equals 1, amount equals $22. Net total equals $648.85. Why the number of vouchers matters. The bank or card issuer can verify they received the correct quantity of documents. It helps detect missing paperwork immediately. If the totals say 16 vouchers but only 15 are included, that is a clear red flag. Why refunds are shown separately. Refunds reduce the amount you receive. Separating sales and refunds prevents overbanking and makes later reconciliation cleaner. Step 3. Imprint the retailer card details on the summary voucher. You imprint the business's card processing details onto the summary voucher using the retailer card. Why this matters? It identifies the merchant account that must receive the money. It reduces the risk of the paperwork being credited to the wrong business. Real-life meaning. This is similar to putting the correct bank account details on a deposit. Without correct identification, the payment can be delayed or misapplied. Step 4. Separate the copies and detach the processing copies that must be sent. The summary voucher has multiple copies. You separate the top copies from the processing copy. Then you detach the processing copy of the summary voucher and the processing copies from the individual transaction vouchers. These processing copies are the ones that go forward for processing by the card issuer, together as one package. Why the book is strict about this separation. The card issuer needs the processing copies to pay the bank, and the bank then credits the retailer. The retailer must retain copies as evidence in case of disputes, chargebacks, or errors. Step 5. Put all processing copies into the card issuer's wallet. The card issuer provides a small transparent wallet or equivalent. You place all the processing copies into that wallet. Key instruction: only the processing copies are sent to the card issuer. Why a wallet is used? It keeps documents together, neat, and less likely to be lost or damaged. It standardizes how the documents arrive, which speeds up handling. Step 6. Enter the net total onto a normal paying-in slip and take the package to the bank. You take the net total from the summary voucher and enter it on a normal paying-in slip. In this example, the amount entered is $648.85. What goes to the bank together? The paying-in slip, the top copy of the summary voucher, which the bank retains, the wallet containing the summary processing copy, and the transaction processing vouchers. Why the bank keeps the top copy? It is the bank's evidence of what you lodged. It supports later reconciliation between the bank statement and your records. Step 7. File what you keep so individual vouchers are easy to find. You keep the second copy of the summary voucher and the retained copies of the transaction vouchers. You file them together in an organized way that makes a single voucher easy to locate. Why the book stresses filing? Queries arise over time, such as disputes, errors, or missing postings. If you can quickly locate a particular voucher, you can resolve issues faster and protect the business from losses. The control logic you must remember from this example: every voucher amount must be captured once and only once. The total and the voucher count must agree with the physical bundle. Refunds must reduce the total and must be visible as refunds, not hidden inside sales. The correct copies must go to the correct place: bank, card issuer, and business records. Filing is not optional. It is part of the process because problems occur after the day of sale, not only on the day of banking. Lesson 5.3: Queries arising from card transactions. In Chapter 6 of the FIA Recording Financial Transactions Interactive Text, Section 5.3 explains a practical reality of card sales. Even when a business follows the normal process for card receipts, problems and questions can still arise later. These queries usually come from the fact that card sales involve more parties than cash sales: the retailer, the customer, the card issuer, and the banking system. Because of that, a transaction can be challenged, delayed, or corrected after the sale has happened. The book groups the most common problems with card receipts into 3 areas, and it explains the typical action or outcome for each one. First problem type: stolen cards. What this means: a stolen card situation happens when a customer pays using a card that was taken from the real cardholder. The retailer may not know this at the time of the sale. What the book says happens. The book's key point is that, as a general rule, if the retailer has followed all proper security procedures, the procedures discussed earlier in Chapter 5, then the card issuer will honor the transaction even if the card later turns out to be stolen. Why that outcome makes sense. Card payments work on the idea of shared responsibility. If the retailer does the required checks correctly, the retailer has acted with reasonable care. In that case, the card issuer normally treats the transaction as valid and pays the retailer. Real-life example. A customer buys goods using a card that is later reported stolen. At the time of sale, the retailer followed the card's security steps required by the system. Later, when a query comes in, the retailer can show that the correct steps were followed, so the transaction is usually honored. Second problem type: transactions above the shop's floor limit. What floor limit means. A floor limit is a maximum value up to which the retailer can accept a card transaction without special approval. When a sale is above that limit, the retailer is expected to obtain authorization. What authorization means. Authorization is the approval from the card system or card issuer that confirms the transaction is allowed. In many systems, that approval is recorded as an authorization code or an approval confirmation in the payment process. What the book says happens. If a transaction takes place above the shop's floor limit and the retailer does not obtain authorization, then the card issuer may refuse to honor the transaction. The book explains the reason clearly. The retailer has been negligent by not obtaining authorization. Why that outcome makes sense. The floor limit is a control designed to reduce risk on higher value transactions. When the retailer ignores that control, the retailer is effectively taking on extra risk. If the transaction is later disputed, the card issuer can reject liability because the retailer did not follow the required process. Real-life example. A retailer accepts a high-value sale without getting authorization, even though store rules require it above the floor limit. If the cardholder later disputes the charge, the issuer may reject the transaction, and the retailer can lose the money because the correct authorization step was skipped. Third problem type: errors in completing the card voucher or in processing. What this means. Errors can happen either when the card voucher is completed incorrectly, or when the transaction is processed incorrectly. Common practical examples include entering the wrong amount, processing the same voucher twice, missing required information, or sending incorrect totals in the paperwork. What the book says happens. The book's point is that discrepancies caused by error can usually be dealt with quite quickly and efficiently through correspondence directly between the business and the card issuer. Why that outcome makes sense. These are not usually fraud issues. They are usually administrative mismatches. Once the business and card issuer compare records, the error can often be identified and corrected. The key requirement is that the retailer keeps paperwork and records well enough to prove what should have happened. Real-life example. A retailer accidentally submits an incorrect transaction amount. When the mismatch is noticed, the retailer contacts the card issuer with the supporting documents. The discrepancy is corrected through direct communication, and the records are updated accordingly. The main message of Section 5.3. Section 5.3 is teaching a control mindset. Following security procedures supports the retailer when fraud happens, such as stolen cards. Following authorization rules, especially above the floor limit, protects the retailer from losing money later. Good documentation and careful processing allow errors to be fixed quickly through direct correspondence with the card issuer. Lesson 6. Banking and EFT POS. What this lesson is about. Lesson 6 explains what changes when a business uses EFT POS, meaning electronic funds transfer at point of sale, to take card payments. The key idea is that card receipts taken through EFT POS do not usually get taken to the bank as paper slips for paying in. Instead, the money moves through the banking system and then appears as a credit in the business bank account. The main rule in the text. When a business uses EFT POS for card receipts, credit card, charge card, and debit card receipts are credited directly to the retailer's bank account. This means the retailer does not normally prepare a paying-in slip and physically deposit those card slips at the bank. How the amounts are checked. The text explains that the retailer can agree the amounts received to the end-of-day reconciliation produced by the terminal. That end-of-day reconciliation is a control document. It is the business's evidence of what card transactions were processed that day, what total value should eventually arrive in the bank. So the practical control is terminal total first, bank credit later, then match them. Timing of the bank credit. The text explains that sales and returns are processed by the card issuers and credited directly to the business bank account, usually within 2 or 3 days. That timing point matters because it explains why the bank statement may not show the money on the same day the sales happened. The narrative on the bank statement. The text also notes that the wording next to the bank account entry, meaning the narrative or description line, indicates the type of service. For example, Maestro, Visa, MasterCard. This helps the business identify what the credit relates to and match it back to the correct end-of-day reconciliation total. Section 6.1, Retention of Documents. Why documents must be kept. Even though money arrives automatically through EFT POS, problems can still arise later, such as queries about an individual transaction, a bank account credit. The text states that, in those situations, the retailer will need to produce relevant copies of the receipts. That is why document retention is essential. What the text requires. The text states that all copy receipts should be kept in a safe place, preferably in date order, for a minimum period of 6 months and sometimes longer. The recommended filing method. The text says it is usually most convenient to attach the day's sales slips and refund slips, including the customer signature copy to the end-of-day reconciliation. Then keep the bundle in date order. This is a strong internal control because it creates one complete daily pack that links what the terminal recorded, what the customer signed, what should later appear as a bank credit. Lesson 7. Banking other receipts. What this lesson is about. Lesson 7 explains that not all money received by a business is paid in by cash or check. Some receipts enter the bank account automatically, and some other types are paid in but are relatively rare. Receipts that require no banking action by the business. The text explains that some receipts, by their nature, require no action by the business to have them paid into the bank account. These include direct debits, standing orders, automated payments, telegraphic transfers. The key meaning is that the bank account gets credited through an arrangement in the banking system, not by the business physically taking money to the bank. In practice, the control focus becomes checking the bank statement, matching each receipt to supporting evidence, such as an advice, a reference, or an agreed arrangement. Other receipts that must be paid in, but are relatively rare. The text states that other receipts which must be paid into the business bank account and which are relatively rare in a business account are banker's drafts, bank giro credits. Section 7.1, Banker's Drafts. What a banker's draft is, in simple terms. A banker's draft is a payment instrument issued by a bank. The important operational point in the text is how it is banked, how it is paid in. The text states that banker's drafts are paid into the bank by the business in the same manner as checks. So from a process point of view, the business treats it like check banking. It is taken to the bank. It is paid in using the normal banking method used for checks. It later clears through the banking system. Section 7.2, Bank Giro Credits. What a bank giro credit is in this lesson. The text explains that bank giro credits can be paid into a bank account by the customer of the business. That means the customer pays money into the business bank account directly rather than giving cash to the business to bank. What the business sees. The text states that in this case, the amounts will appear automatically on the business bank statement, and it refers forward to Chapter 8. So, from a bookkeeping and control point of view, the key task is identify the bank giro credit on the bank statement, match it to the customer and the reason for payment using references and records, record it correctly in the accounting system.